stick with the markets here. Our next guest says he views the tech-related dominance as, quote, unsustainable and under narrow leadership. Dan Suzuki, Richard Bernstein Advisors Deputy Chief Investment Officer, joins us now. Dan, always good to see you. You've had this take for a long time and have missed the rally. So what makes you think this time that's going to come true?
Well, Melissa, I think, we've spoken about this several times. I think, in either scenario you play out, it just doesn't benefit the narrow leadership that you've seen. In the positive scenario where things are getting better, as Mike was just alluding to, there's a lot of stuff out there that's their earnings are going to benefit a lot more. They trade at a fraction of the multiple. And now if things get worse, there's plenty of better places to hide out where actually they do have much more resilient earnings trends. So I think, to me, it's not that these stocks can't do okay, but I think there's just better places to take that risk because there's plenty of things. If things are going to go wrong, and there's a number of different ways that can happen, these stocks are probably the epicenter of where the risk is in those scenarios.
So do you think that there's an inherent fragility to this rally simply because it's the gains are focused in these top 7 stocks?
To some extent, Melissa, I think you're right. I mean, I think this was really a tale of two markets. And so with these stocks being such a big portion of the market, it does, add some fragility to the overall, market rally overall. So I think there's definitely some truth to that. The way I look at it here, there's certainly some positives. I think the profits they do look like they're in the process of bottoming, and that's incredibly positive. Particularly for the more cyclical, cheaper names out there, but overall for tech as well. But I think when you think about the risks, you have an expensive market, as Mike was just alluding to, the expectations for earnings are really high, and there are still risks to that earnings outlook here. And liquidity, to the extent that growth is good, that puts liquidity risk from a policy perspective, or to the extent that things get worse. With this big run in capital market-led liquidity, there's also risk that liquidity could dry up. So if you think about what gets hurt in all those different scenarios, I think the leadership that you've seen this year is probably most vulnerable, especially with the valuation you see today.
In the past, Dan, you've liked China over U.S. markets, and I'm wondering if that still holds, even though we haven't seen the hoped-for stimulus out of Beijing to the degree that investors had wanted it.
Yeah, I think with China, we have to admit that, things haven't been, the typical type of recovery coming out of, a major profit recession, a property crisis, and zero COVID. You think that just with the low base that you would have had a fast recovery, but it is a recovery nonetheless. And I think that in a world where, growth is decelerating, that almost the entire world is in a global earnings recession, to have China that's actually seeing its profits accelerate, even albeit at a slower pace than hoped, I think that's a really strong story. And then the liquidity story behind that, where they're actually trying to stimulate liquidity, stimulate policy, stimulate credit growth, yet nobody wants to own that story, that's a much more favorable risk reward in my opinion.